South Bow Corporation delivered a solid top and bottom line beat for Q2 2026. I mean, revenue came in at $546 million.
Right, which is up 4.2% year over year, totally crushing the 483.74 million consensus estimate.
Yeah, and the bottom line was just as strong. Adjusted EPS hit 50 cents, so that easily cleared the 43 to 45 cent street estimates.
And the GAAP earnings were even higher,
Yeah.
hitting 64 cents. But management didn't just stop there. They actually raised their full year 2026 normalized EBITDA guidance to $1.04 billion.
Right, mapping out that plus 2 minus 1% range.
Exactly. And they bumped distributable cash flow targets up to $665 million.
So imagine beating Wall Street's revenue targets by millions, raising your full year guidance, boasting record-breaking pipeline throughput, and then, watching your stock immediately sink.
It is brutal.
It really is. Despite those stellar headline numbers, this was just a textbook sell-on news event. I mean, South Bow slid, closing down roughly 1.7% on the TSX to $48.98 Canadian.
Yeah, and down 0.4% on the NYSE to $35.34.
Hovering right near its 100-day moving average. So today we are taking a massive stack of earnings reports, analyst notes, and management call transcripts to really extract the real insights behind this Q2 paradox for you.
Because a headline beat never just exists in a vacuum. The market always looks past those raw numbers.
Right. Our mission for this deep dive is to dissect exactly where these outsized profits came from and figure out why the broader market looked at a pretty flawless quarter and just decided to hit the sell button.
Yeah, well, to understand that, you have to look at the quality and the sustainability of those earnings. Digging into South Bow's quarter, you see this wasn't some broad systemic growth across their whole portfolio.
No, not at all.
It was extreme, highly concentrated outperformance. And it was driven by one singular asset.
The Keystone Pipeline System. I mean, that single segment generated $259 million in normalized EBITDA.
Which is massive. And when you look at the delta between the adjusted 50-cent EPS and that 64-cent GAAP EPS we mentioned.
That 14-cent gap.
Yeah, that gap is largely accounting noise. Things like non-cash derivative marks.
Right.
So the 50-cent adjusted figure is the true reflection of their core operational engine. And right now, that engine is basically entirely powered by Keystone.
Well, specifically the U.S. Gulf Coast segment of the Keystone system, right? Because they experienced just a staggering volume surge, hitting a record throughput of 800,000 barrels per day.
Yeah. Moving 800,000 barrels a day means pushing over 33 million gallons of physical crude oil through a steel tube every single day.
Which is wild to think about. But the underlying catalyst for that volume, it wasn't some internal strategic pivot by South Bow. It was pure macro geopolitics.
Exactly. Disruptions in global crude oil trade flows really altered how refineries are sourcing their feedstock.
Because the Gulf Coast is packed with these complex refineries, right? They are engineered with massive cokers to process heavy, sour crude.
Right, and historically they might get that from the Middle East or Latin America. But when global shipping lanes get messy or sanctions just scramble the trade routes, those refinery operators panic.
Yeah, they need reliable, heavy barrels to keep the facilities running. And that forces massive, urgent demand straight up into Western Canada.
So South Bow basically found itself acting as a toll booth on the only open highway during a massive traffic jam.
Wow, yeah, that is exactly what happened. And we can trace the physical evidence of that panic demand shock directly to the major storage hubs.
Yeah, management noted on the call that physical crude inventories at Hardisty in Alberta, which is the main loading hub in Canada,
Right.
and Cushing in Oklahoma, the pricing nerve center, both of those were drawn down to all-time lows.
Refineries were pulling oil so fast that South Bow was literally draining the massive tank farms just to keep the pipe pressurized and flowing at that 800,000 barrel a day rate.
It's crazy.
Okay, let's unpack this, because this is where pipeline economics get incredibly interesting. A midstream company like South Bow operates with massive fixed costs, right?
Oh, absolutely. The billions of dollars required to put the steel in the ground and build the pump stations, I mean, that money's already spent.
Right, so once you cover those fixed operating costs for the day, the incremental margin on every extra barrel you push through the pipe is pure profit.
Exactly, and that operating leverage perfectly explains the drastic margin expansion we saw in this report.
Yeah.
I mean, South Bow's net margin expanded to a massive 23%.
Up from what, like 14.7% just a year ago?
Yeah. And when you combine record throughput with fixed infrastructure, net income just naturally jumps. It was up nearly 40% year over year to $134 million.
And management used that sudden cash influx to repair the balance sheet, right? bringing leverage down to 4.4 times net debt to normalized EBITDA.
Which is huge.
Yeah.
For a capital-intensive infrastructure player, dropping leverage creates a really crucial buffer against future interest rate volatility.
Right. Meanwhile, the other segments were little more than background noise. The marketing segment pulled in just $2 million in EBITDA, mostly dealing with lower volumes but slightly tighter margins.
Yeah, and the intra-Alberta and other segment brought in $19 million, so Keystone really was the sole heavy lifter.
But, okay, here's my pushback. If SOBO is pumping at record levels purely because global trade is temporarily disrupted, isn't this just a fleeting windfall?
That is the big question.
Right, because geopolitical shocks eventually normalize. If this massive beat is built on draining storage tanks at Cushing and Hardisty to all-time lows, that is by definition not a sustainable structural advantage.
No, and honestly, management conceded that exact reality during the Q&A portion of the earnings call.
Yeah.
I mean, you cannot run a pipeline system at maximum overdrive perpetually when the upstream storage tanks are empty.
Yeah, eventually you just hit the tank bottoms.
Exactly. And your pipeline throughput becomes strictly capped by the daily production rates coming out of the actual oil wells.
Right.
They openly acknowledge that the red-hot Gulf Coast demand is going to moderate as supply chains adjust, and those depleted inventories are forced to reset.
Because you eventually run out of store oil to pump. Which, brings us to the most critical pivot of this deep dive. The market knows Q2 was an anomaly. Investors are looking past the temporary cash pile and scrutinizing what SOBO's doing with that money to secure permanent long-term growth.
Yeah, and their answer to that was a massive, completely unexpected hike in their capital allocation targets.
They increased their 2026 growth capital expenditures guidance by 800%.
It's a huge jump. They took the original target of $10 million and bumped it all the way up to $80 million.
And the allocation of that capital is incredibly revealing. Of that $80 million, $65 million is specifically earmarked for pre-FID development costs.
Right, and pre-FID stands for Final Investment Decision. This is the really expensive, totally unglamorous phase before a company even officially commits to building a project.
Yeah, they are spending $65 million on the Prairie Connector and the Liberty Bridge pipeline projects, aiming for a mid-2027 FID.
And that money, it pays for front-end engineering design, environmental baseline studies, stakeholder and tribal engagement.
Securing complex right-of-way easements from landowners.
Exactly. It is literally tens of millions of dollars spent pushing paper before a single piece of steel is even ordered.
But they are willing to sink that capital now because of the commercial results of their recent open season.
Yeah, an open season is a regulatory requirement where a pipeline operator solicits bids from shippers just to gauge commercial interest in a proposed route.
And CEO Bevan Wurzba highlighted this as a major structural victory. SOBO secured 465,000 barrels a day in 20-year binding customer commitments for the Prairie Connector.
Right, with the potential to eventually expand that system to handle over 800,000 barrels a day.
I mean, convincing oil producers to lock themselves into 20-year binding contracts is the ultimate proof of concept.
It really is. It demonstrates that the demand for egress out of the Western Canadian Sedimentary Basin isn't just some temporary geopolitical blip.
No, it is a long-term structural bottleneck that producers are just desperate to solve.
Yeah, but here's where it gets really interesting. They've essentially sold out the VIP tickets to the stadium for the next 20 years before the stadium is even fully approved.
Right, so the commercial risk is practically zero. The revenue is locked in on paper.
Exactly. But the hurdle is transitioning those paper contracts into physical infrastructure. Because building a pipeline in North America today requires navigating a legal and regulatory labyrinth.
It often takes longer than the actual construction.
Oh, absolutely.
Which perfectly explains why the stock sold off on a massive beat. The market just hates uncertainty.
Investors looked at the quarter and realized, the easy money has been made. The next phase requires navigating a multi-year gauntlet of environmental reviews and federal permitting.
Yeah, CEO Wurzba hammered home a specific phrase on the call, permit durability. He made it clear they won't pull the trigger on that mid-2027 FID without it.
And permit durability is really the holy grail for modern infrastructure projects. Securing a permit to build is just no longer enough.
Because opponents of fossil fuel infrastructure have completely mastered the art of weaponizing the judicial system.
Right. They will wait until a company clears the right-of-way, starts pouring concrete, and then file an injunction under the National Environmental Policy Act or the Clean Water Act.
Just to halt construction completely.
Exactly. Billions of dollars can get trapped in legal limbo for years. So WRSBA is demanding regulatory certainty, permits designed to survive federal court appeals before authorizing that heavy capital spend.
And while investors are trapped waiting for that mid-2027 FID resolution, they also have to digest some near-term operational realities, right? Management provided explicit guidance that the back half of 2026 is going to be softer.
Yeah, they projected Q3 EBITDA will fall roughly 10% sequentially from Q2's $280 million high water mark.
That is the hangover from the Q2 tank draining party.
It is. But normalizing demand is only part of that Q3 equation. The other half is a strictly enforced physical cap on their throughput tied to the MP-171 remediation.
Right, milepost 171. That refers to the major pipeline rupture that occurred in Kansas back in 2022.
Yeah, and operating a pipeline requires intense fluid dynamics. You rely on massive pressure to push heavy liquid over thousands of miles.
So when a pipe ruptures, federal regulators step in and they mandate a lower maximum operating pressure across the affected segments, just to prevent another failure.
Exactly. Chief Operating Officer Richard Pryor confirmed that those pressure restrictions are still dragging down the system.
Because lower pressure fundamentally limits how much volume you can move. It caps your operational flexibility.
And the regulatory mechanism to lift those restrictions is just agonizingly slow.
Oh, yeah. Regulators require the company to run specialized inline inspection tools, those things known as smart pigs.
Right, and they have to conduct extensive metallurgical testing before they allow any phased pressure step-ups.
And Pryor warned that this phased lifting process is going to drag out through the end of 2026 and well into 2027.
So the physical reality of MP-171 creates a hard ceiling on their near-term earning power, regardless of how desperate Gulf Coast refineries are for Canadian crude.
It forces the company to allocate continuous capital and engineering focus toward remediation rather than just pure growth.
Exactly.
So what does this all mean for you? Are retail investors looking at a classic yield trap? Because the board declared a quarterly dividend of 50 cents Canadian.
Which translates to a seemingly fantastic yield of around 5.64%.
Right. But looking at the core financial metrics reveals a massive underlying risk. The payout ratio currently sits at a lofty 109.9%.
Yeah, meaning they are literally paying out more cash in dividends than they are generating in bottom-line net earnings.
And a payout ratio over 100% usually triggers immediate alarm bells across retail portfolios.
It does, but, analyzing a midstream pipeline company requires looking past GAAP net income.
Right, because pipelines are massive physical assets that depreciate heavily on the balance sheet over 30 or 40 years.
Exactly. Depreciation is an accounting expense that drags down net income, but the company isn't actually writing a physical check for that depreciation cost today.
Which is why the industry relies so heavily on distributable cash flow, or DCF. DCF adds those non-cash accounting charges back into the equation.
It provides a much clearer picture of the actual cash moving into the company's bank accounts.
So when management bumped their distributable cash flow guidance to $665 million, they were basically signaling to the market that the physical cash generated by the business can still cover the dividend checks, even if the net income metrics look completely upside down.
Right, and the analysts in the source notes project the payout ratio will improve next year, potentially dropping to around 98.5%.
But even factoring in the non-cash add-backs of distributable cash flow, hovering anywhere near a 100% payout ratio leaves zero margin for error.
None. If the company suffers another mechanical failure like MP-171, or if global crude supply chains suddenly stabilize and throttle Gulf Coast demand faster than anticipated,
that 5.6% yield goes from being an income generator to an existential threat to the balance sheet.
Absolutely. The combination of all these factors is basically the blueprint for a sell-on news event. The market didn't reject the strong Q2 numbers.
No, the market aggressively repriced the stock based on the realization that SOBO is entering a transitional utility-like phase.
Yeah, for the next 12 to 18 months, investors are staring down a heavy capital spending cycle.
Sequential earnings declines in Q3.
Capped operational throughput from legacy incidents.
And massive regulatory uncertainty surrounding their only real growth engines.
Capital appreciation is effectively paused right now. The $65 million pre-FID spend is totally necessary, but it does not generate immediate returns.
Right. Investors are essentially being paid a 5.6% yield just to sit patiently and absorb execution risk.
And the broader market refuses to bid the stock price higher until management delivers tangible proof of permit durability and officially greenlights the Prairie Connector.
There was also a board transition mentioned in the filings that perfectly mirrors this whole corporate evolution.
Oh yeah, Hal Kizel stepped down as board chair. with George Lewis taking the reins.
Right, because SOBO was spun off from TC Energy relatively recently. Kivzel guided them through that initial spin-off and stabilization phase.
But now, the company has to prove it can independently execute complex, multi-billion-dollar capital projects without the protective umbrella of a larger parent company.
So Lewis is stepping in to oversee this highly scrutinized, basically prove it phase.
Yeah. And the tension here really defines the modern energy infrastructure space. You have this highly profitable cash cow generating massive temporary profits by leveraging existing assets during a global supply chain crisis.
Right.
But at the exact same time, you have the unforgiving reality of a multi-year, capital-intensive, politically fraught environment where spending tens of millions of dollars doesn't even guarantee you the legal right to break ground on new projects.
It forces a fascinating question about the macro landscape of North American infrastructure for you to think about. I mean, as the legal barriers, environmental reviews, and timelines for new construction continue to stretch into decades, the existing steel already buried in the ground becomes infinitely more valuable.
Right. The toll booths that already exist can just charge a premium.
Exactly. But the companies operating them are forced to transform. They shift away from being dynamic growth engines and basically turn into pure cash flow management vehicles, carefully managing their decline rates while handing out high yields just to keep investors placated.
Because when you look at a massive dividend yield in the pipeline sector, you aren't just buying access to their current operational cash flow. You are pricing in the regulatory and political risks of their future expansion plans.
Yeah, the market looked at SOBO's record-breaking quarter and decided the legal hurdles of 2027 simply outweighed the cash generation of 2026. Keep that dynamic in mind the next time you see a company crush Wall Street's estimates only to watch its stock slide into the red. Understanding the mechanics behind the headline numbers is really the only way to avoid the traps.
Yep, you have to look deeper.
And if you want to stay ahead of the curve on how institutional decisions impact retail portfolios, make sure to follow the show for our daily earnings coverage. We will keep tearing apart the source material to find the signals hidden in the noise.